My name is Gayatri, and on behalf of WIGIL, I'd like to thank everyone who's joined us at 8 o'clock. I think this is going to be a very interesting session, and men, women, doctors, non doctors, everyone alike, it's something that we all need to understand and get on board with. And I'm happy that we have a very special speaker here with us today. This is Dr. Anil Kumar, a senior pediatric surgeon from Bangalore, and he will be taking us through the nitty-gritties of financial management, maybe a topic that's a bit, at least for me, a bit of a gray area, some stuff that I don't really understand. So I'm glad to have him with us. Um, Dr. Manpreet from AIIMS will be moderating the session. Dr. Shruti, unfortunately, couldn't join us as she was held up in a transplant. So I'll hand it over to Dr. Manpreet to introduce the speaker in detail and get the session started. Manpreet?
Good evening, everybody. Dr. Gayatri has already introduced you to the topic for today, that is investing for beginners. As doctors, we focus a lot on all the things that we are doing in our work life, but we often ignore money matters. But money does matter. So today we welcome Dr. Anil Kumar, who's a pediatric surgeon, but also very good with the investing. He has been holding multiple sessions regarding the same in multiple conferences and also hosts a WhatsApp group, which Sir will tell us about. Over to you, Sir, please.
Yeah, thank you very much, madam. And thank you all for joining. And thank you, Vigil Group, for giving me this opportunity. Yes, this is my favorite slide, darkness to light and ignorance to the knowledge. It's a story of all the doctors, all medicos. So we don't get exposed to the finance world from the starting of our education till the end of our education. We just into the medical field, and it's a struggle. And once you finish your education, again, your practice and upgrading the skills, 100% we are involved in our own profession. But you all know that along with the profession, yes, finance is also very important. So we ignore not by chance or by choice. It's just that we do not get exposed to that in our journey. But it is a time that you need to learn. So unlike like any other our medical profession, like MBBS, then you do the post graduation, super specialty, PhD, like that. Even in the finance, all the steps are there. Finance doesn't mean that okay, 1 hour I'll talk and you become a finance expert. No, it is not like that. But it's still possible with less time, with less knowledge. Today, what I'm going to talk is you can invest and you can earn even without a finance knowledge. You just require the guidance how you can able to do that. See, these are the myths we have among our doctors. No, it's not my cup of tea. I don't understand. I don't have time. And the beginners, I don't have capital. Let the expert manage it. Let the agent manage it. Or my spouse manage it. No, I know I want to learn, but I don't know where to learn. Or most of the people, yes, money comes to your account and just lying in your account. Or at the most, you may put the money in the fixed deposit forms. Or yes, insurance. That's the commonest place where you keep the money, either FD or the insurance form. So, as Madam said, I'm Dr. Anil. I'm a pediatric surgeon and a proud Wealthconian. And this lecture dedicated to my mentor, Dr. Ramnath Gute, who is the founder of Wealthcon and the Healthcon. So we in the Wealthcon try our best to teach the finance to our doctor colleagues. We have reached more than 90,000 plus across country to teach the finance. So it's an educational platform. We are not the SEBI registered agents. BSwan. So as Dr. Gayatri said, she is the new to the finance. The many in the group may already know and investing it. So whichever the point suits you, you can pick up. You should know the finance education is very important. The life expectancy is increasing. The cost of living is increasing. And important is children are not our retirement plans. It's very, very important things. And you should never outsource investment decision to anyone else. So you
Yes.
should understand why I'm telling that keeping the money in the bank or as a deposit, why it is not good. There's a concept called inflation index. You all know the inflation. The whatever the material or object, the whatever the price today, by next year it increases. So that is called inflation. It's around 6% in India, the inflation. That means if you have 100 rupees, the value of the 100 rupees is 94 rupees by next year. Even though it is 100, the value is 94 rupees. But for the doctors, the inflation is bit more than the general public. Why? Next. Gayatri, next. No, I can't. Oh, yeah. See, the inflation depends on the two factor. One is the price, another one the lifestyle. What the 6% we are talking about, it's about the price. The second part is the lifestyle. In the sense, the way you live, the way you use the vehicle, travel, the holidays, kids, schools. So all those things add to the inflations. At least 8% we can consider as an inflation for the doctors. Yeah, next slide. So example here, if you keep the money in the FD or a bank in an FD form, maximum you get a 7% interest. If you are a 30% tax slab, then you get a post-tax return of 4.9%. Okay. If the inflation is 6%, for doctors it is 8%. So out of 4.9%, if you minus the inflation, what you get is minus 3%. That means if you deposit 1 CR in a bank as an FD, by 1 year, your money value is a 97 lakhs. That means 3 lakhs less than what you invested. That means the money is decaying. If you want to keep the money intact as it is, at least 8% return you should get. Then only your money is same as what it is. Just by seeing the value that 6% increase, 7% increase, 4% increase doesn't mean that your money is growing. Next. So remember that there is what is called as an active income and the passive income. So employee, self-employed and small business, where you have to work day to day to earn the money. We all noticed during the COVID what is mean by the active income. The freelancer experienced this a bad reality. The passive investor is passive income means is an investor or you have a business owner or you have some rights where you don't require to work day to day, but still the money is coming. That is called a passive income. So you should aim at that part also, apart from what we are doing as an active income, like you working, earning, but the earned money has to earn back. That is what we need to aim at. Next. See, there is a, this is for the juniors. Generally, we explain that Parkinson's law. That no matter how much money people earn, they tend to spend the entire amount and save a little. This applies to all, and most of us experienced as an interns, you earn 3,000, 5,000. Now, as a consultant, you may be earning in lakhs, but the saving is not increasing proportionately. So, hence, saving is very, very, very important. Next. So, there are three group of people: the people with low income and the low asset, the people with high income and the low asset, and the people with high income, high asset. We come to the second group, what is called high income, low asset. That is only because we are not saving in a correct form. Yes, next. So generally we suggest at least 20%. That is the minimum. 20% of what you are earning should go to the saving account. So hence, there's a three account formula. That means there is a salary account where the money comes to you, and you have two more accounts. One is called investing account, other one is called expenditure account. So minimum 20% has to get directed to the investing account, no matter what. So out of the 80%, it comes to the expenditure. It's not that you should spend 80%. So over a period of time, you know how much is left in your expenditure account. Accordingly, you can adjust that amount so that that much amount will go to the expenditure account and remaining go to the investing account. It's a good idea to have the splitting these accounts so that the monitoring will become easy. Yes, next. So what is the difference between the saving and the investment? Or what is an investment? Say buying an appreciating asset is called a investment. Next. So what is that appreciating assets? Anything which pays you back, they are called the appreciating assets. Yes, next. Anything which takes away, yes, next, will is called a liability. Next slide. Next slide. Yeah. So there are true assets and pseudo assets. Many times we get fooled by having a pseudo assets. What are the true assets? The asset which is easy to sell and there is no emotional involvement in that. The example, you have a cash, you have an FD, you have policy, mutual fund, shares. These are all called a true assets. Whereas pseudo assets is it's difficult to sell. Emotional involvement in the asset. So example like you have an house, your car, furniture, gadgets, jewelry. These are called pseudo assets. Not that you should not have the pseudo asset, but your main aim is to increase the true assets. Next. If you're coming to the assets, we classify them into the three categories. One is a physical assets. The second one is the financial assets. The third one is called intangible assets. You all know the physical assets, the gold, real estate, and machineries. The intangible you can create, like having a patent, copyright, trademark, brand. So you get that amount. That is called intangible assets. The second one is the financial assets. In that, there are two categories, what is called equity and debt. The meaning of these things, coming to the debt, see in the investment, there are four factors. One is the money which you are investing, how much return it is giving, how long you are keeping that money, at the end, how much money you are getting is. These are the four factors. When all these four factors you know, that is called a debt product. Example is FD. So when you keeping the money, you know so and so money you are keeping. This is the expected return, and this many years you are keeping. At the end, this is the amount you get. That those are called a debt product. We call these are a money protecting in the sense it remains. The growth won't be there. At least it remains what it is. The equity, that is the second part of the finance. The equity means if you take a company and you liquidate the company, clear off all your loans, what remains is called equity. Next. So in the financial products, no, there are three categories. One is called wealth creation, wealth protection, wealth destruction. As I explained, if you keep the money in the long-term FD, that money is decaying. Earlier I showed the example. And the Ponzi schemes where doubling money is going to double in a month, 6 months, 1 month. These are all called Ponzi schemes. If you keep the money, yes, definitely you're going to lose it. And third is ignorance policy, where most of us filled with these policies, life insurance policies. And coming to the wealth protection, these are more of debt products. Just now I was explaining what is that debt product means. The PPF, NPS, debt mutual fund, and short-term FD. You are keeping the money for short-term sake. These are called wealth protection schemes. And coming to the wealth creation, it's only possible with the shares and the equity mutual fund under financial products. Yes, next. Just a concept about the diversification. So when you keep the money, you have to diversify yourself. You cannot keep all the eggs in a single basket. We say the grid formula for the young people. The gold is 10%, the real estate 40%, the equity is 40%, and the debt product is 10%. This is what approximately in your portfolio maintain this. So for the equity, the formula is 100 minus age. Younger the age, you should have more exposure to the equity. Older the age, the equity exposure should be less. Because in the equity to earn the money, it's not that you're going to put the money within a week or a month or a year, you're going to increase the value. It is an horizon of 5 to 7 years. When you keep the money for a 7 years in equity, almost all the time your money grows to the expected level. Next. Yes. So coming to the topic, what we are discussing now is the tradable securities. Tradable means where you can buy and sell. That is called a tradable securities. Like a medicines, no? If you take paracetamol, that is the generic. When it packaged, it is called Calpol, Crocin kind of a thing. So in the generic, there are three. One is called shares, second one is bonds, and third one is debenture. So we're going to talk about the shares. So shares means it's a part of a company. Okay. There are various terminology for that. So stock, shares, these are the terminology used. You cannot buy the whole company, but you can buy a part of the company, what is called a shares. Okay. Bonds, again, these are all debt products where the government give the bonds and you are going to give the money to the government give the assurance. So here also the same. You have money invested, how much interest you are going to get, and at the end, your money comes back. Debentures are similar to the bonds where the private company gives. So coming to the shares, that's the equity product. You can buy directly the shares, that is through the demat accounts. For that, you require a knowledge to know the company's name and fundamental analysis of the company, whether the company is good, bad, can I invest, is a growing company, what type of company, all those things. You require a bit more knowledge to buy a shares. There's a possibility that they may give a good return. There's a possibility that they may go down. So you should have a knowledge to know how long you can keep these shares or when to sell it. Okay. So the beginners, instead of going to the shares, there is one more, a package product, what is called as a exchange traded funds. And the second one is a mutual funds. So we'll discuss about the exchange traded funds. Yes, next. See, in the stock market, no, there is a terminology called index. Like we say index case, no, similarly the index. There are thousands of companies, 4 to 5,000 companies. So the top 50 companies bunch together to form an index. So that is called a Nifty index. The top 50 are called the Nifty index. Next 50 are called junior Bs. Okay. So in this, it is created in such a way that they take the weighted average. I don't go into the detail about how it is formed. It's not required to know that. But if you know what is exchange traded funds, that's more than enough. Next. So what is this Nifty Bs? These are all called the exchange traded funds. They invest in Nifty Indian companies traded like a stock on the exchange, like how you can buy the shares and sell. Similarly, you can buy and sell. These are all good for long-term investing. Low expense ratio. What is that expense ratio? Whenever there is a package product, no, the person who makes that package, we need to pay. That is called a expense ratio. These will have a very less expense ratio, and it's a diversified portfolio. If you take the Nifty index, no, 50 companies are bunched as a one unit. Okay, when you buy 1 unit of Nifty Bs, that means you are investing in a 50 companies as a part amount. So these are called a Nifty Bs. Next. See, this is the chart that I've just taken the last 10 years. Okay. If you see in 2016, the mark is around 81 rupees. Right now it is trading at 295. So almost 256%. 3 times your money has grown over a period of 10 years. Next. If you take to the next 50 companies, the Nifty Bs are the first 50 companies. The junior Bs are next 50. That means 51 to 100 companies. So if you invest in both these things, that means you are investing in top 100 companies in a stock market. See, the 50 companies may not be the same 50 throughout, but top 50 remains top 50. So you don't require to see whether this company is going to grow or not. So whichever is best, they come to the top 50. So you can just pick up the Nifty Bs as a one unit. That means that includes the top 50. When you take junior Bs as one unit, that includes the next 50, that is 51 to 100. Just see the amount of growth. It's almost 233% over a period of 10 years. That means more than triple the amount in 10 years. Yes, next. Just to understand what I'm talking about, the percentage, the double, triple, what does that mean? So 6%. Say some banks say that we give 6% or FD you keep 6%. If your money start growing at 6% per year, it takes 12 years to become double. If you keep 1 lakh, the 1 lakh to become 12 lakhs, if the percentage of return is 6%, that means it takes 12 years. So that is an FD. If it is around 8%, then it takes 9 years to double the money. Those are all our PPF and SSY. There are debt products. If you get a 12% return, that means in 6 years, money doubles. That's what index return is. If you take 15% return per year, that means it take around 4.8 or 5 years to double the money. That is Nifty Bs or ETF, what I am talking about. And if you take 20%, then it takes 3.5 years to become double. Those are the junior Bs. When you combine Nifty Bs and junior Bs, around 15 to 16% return what you are going to get on year basis. Next. So this is the data in the Google what I got it. And over a period of years, you see that the Nifty Bs, junior Bs, last 20 years, if you take now, on an average, the return is like 13.5%. If you take last 5 years also, the return is 20%. It's not an absolute return. It's an year-on-year return, what you are going to get. Yes, next. So always says it's not difficult to become a crorepati by retirement age if you start early. So you can check it in calculator in the Google. I just calculated. If you just start investing 5,000 rupees per month in an index, that is 12% return what I have calculated. By 35 years, the invested amount is 21 lakhs and your money grows to 3.25 crores. Next. If you invest in the junior Bs, junior Bs, yeah. So that money grows to 5.5 crores on an average of 15%. For this, early starting is very, very important. You may say that, no, we don't have 35 years, but still you can get this knowledge to start to your kids so early. As soon as the 18, 20 years, if you start investing in their name, even if you just invest 5,000 per month, which is quite possible, throughout 35 years, if you just invest 5,000, you become crorepati without much effort. Yes. If you think next, if you think that 5,000 is too much, next. So this is for 40 years. That keeps increasing. As the time increases, the compounding factor kicks in and the money start doubling. Yes. If you think that 5,000 is too much, even if you keep 2,000 per month for 40 years, that money becomes 2.38 crores. Yes. So same thing. I'm just calculating if 12% and 15%. What I'm trying to tell you here is even with as small as amount, next 1,000 rupees per month also if you invest over 40 years as an average of 12%, still you can become crorepati. Yes. Next. Next. So this is what I am telling. See, in 1996, the top 50s are on the left side. Now in 2024, of course, this is the old slide. The top 50s are this much. Only in the center part, what you're seeing, those are the companies which remain. Whereas on the left side, all the companies disappeared from our top 50 and the new company have added. You don't require to monitor those companies. This happens automatically. So you don't require a knowledge about the company, which company is there in the top 50. If you just know how to buy the new ETF, that is Nifty Bs and Junior Bs, that is more than enough. Yes, next. See, why I'm telling this is what the growth of Indian economy. Okay, if you say from 2000 to now, it is just growing upwards and it's going to grow in the same manner. So hence, if you invest the money, the growth is certain. Next. Yeah, this is what the expected growth. So 3 trillion already we crossed. We are going to going 6.6, 13.6, 30 trillion. See, this is the economy. Where is that money? That is nothing but the stock market, what we are talking about. So if the India is growing, or economic growth is happening, automatically your money also grows. Yes, next. So how long you have to invest it? This is very important to know. It's not that you invest the money, next month you get the profit or next year get the profit. If you see this chart, no, the 1st August 2019, just to explain, I have taken this chart. In a year time, the money has gone down. That means the money which you are invested in the equity, I'm telling that it's going to grow, money is going to grow. But if you invest for 1 year, your money is down. So if you keep the same money for the 7 years, see where is the growth. So if you see this chart, you can understand why we are talking about the minimum period of investment in a stock market in an equity is 7 years. Yes, next. So we always say, our mentors say, education without application is pure entertainment. So you just start uh, investing or you have to apply what you learned today. Next. So it doesn't take much time. You know how to open the account, bank account. So your money comes to the bank account. It is there in the bank account. So exactly similar way, you can open what is called as a demat account. So you require, these are the few documents which are required. It is just a 5 minutes job in the online. People who are not having a demat account, I'm explaining to them. Once you open the demat account, the money, you need to make a way for the money to come from your bank account to the demat account by SIP form. So money comes to your demat account on a monthly basis. Once it comes to your account, you can have a order in the demat account to buy on behalf of you. You can create what is called as basket. There are methods to do that. Once you create the basket, for example, okay, monthly I want to invest 10,000 rupees. So you create a basket of Nifty Bs and Junior Bs for that amount. So on so day the money comes, the money or that in the demat account, the buying happens. So only one time job for you to open the account, create the the NEFT money to come to your demat account, and the basket creations. That you can, depending on the income, how much you want to invest, you can keep changing it. It's not the big thing, it's a one-time thing. Once you do it, you don't require to open your account and see day-to-day basis what is happening. As I showed the previous slide, how the Nifty grows, your money will be keep growing. Yes, next. Yeah, this is what we say, create a basket of Nifty Bs and Junior Bs and create a SIP in a bank to transfer money to the demat account. No need to watch the account for few years. Your money will grow on an average 12%. Yes, next. So whenever you want to stop, let me know, Dr. Gayatri. I have many slides. I'll keep going till you say stop. So the power of compounding, that's what I was showing, keeping 1,000 per month, 2,000 per month. If you see this chart, no, the person who started investing at the age of 20 and the person who started investing age of 35 years. If you take this 20 years side, yearly investment is 6,000, invested for 15 years and stopped investing. That means total investment is 90,000. By retirement, the amount is 28 lakhs. In the other side, you see, in the 35, the year investment is 13,000, almost double the money what the 20-year person is investing. And they invested for 30 years. Again, they double the amount, the duration of this 20 years fellow. And total invested is 3 lakhs 90,000. The retirement amount is 21 lakhs. So it's very, very important to know, start early for the compounding effect to kick in. Yes, next. I think it's muted. It's for the two-way communication. This chart, what I put. If 1 rupee become 2 rupees next day, the 2 rupees become 4 rupees next day. So if it keep happening by 30th day, how much will be the money? You can just imagine yourself. I'll show the chart. It is unimaginable. Yes, next. So this is what? 53 crores by 30th day, the amount. That means the doubling. I am telling 30 times doubling. 1 rupees will reach the 53 crores. So this is the effect of compounding. When you invest for 20 years, the money may be 2 crores or 10 crores. As the time progresses, the money become double and it kicks in. Yes, next. So this is the formula to say the compounding effect. If you say A is the amount invested, say A is the amount you are going to get, P is the amount you invested, the 1 plus R% is the return to the power of N. The compounding effect comes there, power of N. It's not about how much you invested. It's not about how much return you are getting. It is about how long you are invested. So it's the power. So if you see this chart, no, in 2010, 1 kg sugar was around 10. Now it is 50 rupees. The gold 10,000. Now it's almost 1,30,000. And land 5 lakhs to 4 crores. If you take Nifty, 6,000 to 26,000. That's what the growth of our index is. Next. I think I'll stop at this level and we'll discuss if any questions. So my point here is you don't require much knowledge in the stock market. Yes, if you have a more knowledge, your earning is more. Even without having any knowledge, still you can earn money. That is 12 to 15% what I shown. So anything less than 80%, your money is decaying. So hence, you need to find a vehicle which gives more than 8% returns. So index is the one which give 12% return. You just mix up with the top 50 and the second 50, that is top 100 companies, somewhere up to 15% you can aim at. Yes, madam.
Thank you, sir. That's a wonderful presentation which tells us how important it is to invest. So, before we open the floor to questions, I had a couple of questions. Uh, First thing, opening a demat account on your own in your own bank versus using an app such as Zerodha or one of the others? Is there any advice on which one to?
This Zerodha is a zero broker account. So the charges are very, very minimal. Whereas in your bank, they are the paid accounts. So the charges for the transactions will be more. So better to have a zero broker accounts.
Right, sir.
If
And
you already have Demat account, yes, you can continue with that. But you are starting, so it's easy now. So better to have a this zero broker accounts.
And sir, so when you go onto say an app such as Zerodha, for example, I just opened one for to discuss. There's multiple terms which come, and I think a lot of times I've thought of starting a an SIP, but I get confused. So, for example, they will ask, they will be something about exit load that is there. There is what you said, the expense ratio. So, what all points to be seen, like apart from Nifty 50 or Junior Bs, if we are trying to look at other funds or other investments as well, are there some basics to look at what is to decide which is a good fund or good place to invest in?
Yes, there are three parts here. The what I covered is the first part, wherein zero knowledge and still you can earn 12 to 15%. That's what I try to explain in this particular session.
Right, sir.
And the next level is like finding the best stock and investing the stock and diversifying the stocks. There are 12 to 15 sectors in the market, like pharma sector, IT sector, bank sectors. Like that, there are 12 to 15 sectors. You need to identify 12 sectors, each sector two stocks, total at 2 dozen, that is around 24 stocks, which you need to invest on. But how to find out those two companies in a sector is the next part of the discussion. So we have a guidelines for that. There is a criteria called MPTDS, wherein we look for the market capitalization. We always look at the bigger companies. We don't look at the new companies, the established companies. And we need to see how is the price, in the sense year on year, the value or the price should keep increasing. And the company should pay tax and dividend. Okay. See, we always say, our mentor always say, these are the two factors, tax and dividend, where company won't manipulate. The tax means they are going to pay to the government. Why would they say we earned more and pay more tax? No. The dividend is the profit which they are distributing to the shareholders. Why honestly they'll give more dividend to you? So these are the two factors, very genuine. Any other factors in the company can be cooked up. And the sales, year on years, how the sales are increasing. So these are the 4, 5 factors we look at, and whichever the company fits to these 5 factors, then we select that is a good company. So like that, out of 12 sectors, you need to find. There is a website called screener.in, www.screener.in. If you go there, if you just search the company, there are 5,000 companies. If you put one criteria, that is market capitalization more than 10,000 crore, out of 5,000, suddenly it decreases to 350 crore, 350 companies is the one criteria. Then all those criteria you can apply and you can find the best stocks. This is finding the best stock. The third part is a mutual fund. So mutual fund, similar to the ETF, what I am talking about, the bunch of companies, okay, is the mutual fund. These mutual fund are created by the fund managers. There are AMC companies, fund managers. They create these mutual funds. So you can buy the mutual fund also. Again, we have a criteria to find which is the best mutual fund. That is little more elaborate. I cannot tell you in 1 or 2 lines like how I explained the stocks part. But important point to remember in the mutual fund is one is called a direct, other one is called regular. If you have taken through the agent, they're all mutual fund the regular. But what you have to buy is mutual fund direct. So what is the difference is, see, like to create the fund, the company creates, AMC company creates, and to sell it, there is a intermediary. So at least 1 to 2% of the money you are keep paying to the agents when you buy mutual fund regular. See, it is like you take a uh, flat for 1 crore rupees and you pay 1% to the agent, that is 1 lakh. Correct. Just imagine each year if that agent comes to you and asks for 1 lakh, are you going to give? It's one time you give, but year on year you don't give 1 lakh, no? So
Right.
that is what you are doing it in a mutual fund regular. Whether that mutual fund grows or not, still you have to pay the money. Okay. So 1 or 2% looks small, but if the mutual fund is earning you 10%, so 1 or 2% is 10% of your earning, what you are giving it. At least in the mutual fund, if you remember this point, is more than enough. That is, you have to buy mutual fund direct. If you are already having it and they're giving the good return and they are regular, very simple way, once you open the accounts and same mutual fund, you can buy as a direct. You can sell these things and you can buy. That's why at least you can use another 1 to 2%. This 1 or 2% what I'm talking it, again it looks simple, but when you keep it for a long period of the time, that 1-2% compounding itself becomes a crores. That's what you are paying to the agents. Yes. Thank you.
Sir, also, so Nifty 50 and Junior Bs, like you said. So there is a share also for Nifty 50 and a mutual fund also with Nifty 50. What is the difference between those two?
See, like similarity is the same in the sense there is a Nifty mutual fund where the companies are there, and the Nifty ETF where the part of the company is there. So one is the expense ratio. Second thing, again, ETF is created by the index, so the charges are less, whereas the mutual fund is created by the AMCs. See, like it's like a classroom. The index is itself is the benchmark. So all mutual fund, it's not possible to beat the index. So maybe 3 to 5% who can beat the mutual index, but nearly 80 to 90% of the mutual fund won't beat the index. And the other thing is, it can be small amount. See, one unit of index, it's cost 250 or 290 rupees. Even if you don't want to put too much money, even 1,000 rupees means you can get 3 to 4 part of the ETFs. Like the expense ratio is less, and you can buy, and they're in the real market ETFs. Whereas mutual fund charges, they happens after the day ends. So its ETFs are like directly buying like a shares kind of a things. If you're having the index, yes, I'm not telling that it's not bad, but ETF is better than the mutual fund over a period of time. The initial period, it may looks same or similar. As I said, that 0.5%, 1% difference, you're going to see for a period of 15, 20 years time.
Right, sir. And sir, so we've talked about investments. What about bonds? I know that gold bonds used to be a very good investment at one point. Any bonds that you suggest for doctors or people who don't have
The
a clear
bonds,
idea?
yes. In the bonds, no? Yes, these SGBs also called bonds, sovereign gold bonds. Yes, it's a very good investment. Now, for various reasons, the government has stopped issuing the government SGBs, but still they are available in secondary market. So why we are telling good is, one is it gives around 8% return year on year, and that is an interest what you earn plus the gold appreciation, the asset appreciation and the interest. So which is good, and it's a safer, like you don't require to keep in the locker. So, and it is a tax free. If you keep it, it's a 8 years period, SGBs. And when you take into the secondary market, whatever the duration left, if you keep that much year, no, then it's a tax-free. Hence, SGP is the one. Other thing is there is what is called as government security bonds, G6 bonds. Okay. So these are all like a debt products. They give anywhere between 6.5 to 8% returns. Once the return is fixed, that is throughout the tenure, you are going to get that much percent of returns. So it is like, as I said, no great criteria: gold, real estate, equity, and debt. So for the debt, you can keep these G6 bonds. All these things available in the demat accounts. Usually Tuesday to Thursday, they come as a primary, and you can buy those things.
Right, sir. So we will open the floor to questions. Anybody who has a question, please can raise their hands and sir can answer.
Dr. Mohan, if you can unmute yourself.
Thank you for the nice advice and presentation in a nutshell manner, that too from a doctor.
Thank you, sir.
Because I think doctors are not so good in finance management, but you are one of the exceptions who has mastered in the finance management.
So
That's
there are many are
really
there. Yes, that's one of the aim.
that is really appreciable, because I don't say you are one, but very few people, those who are, of course, present generation they are doing. I don't deny that, but still, in comparison to other professions, doctors are not so good. Uh, well, my question is, what's your advice for the senior citizens for investment who are 70 plus?
So usually
And,
for 7, yes,
not
sir.
getting pension.
Yes, yes. Usually 70 plus, as I said, no, sir, equity investment is little long-term investment.
Yeah,
You
but
cannot
we don't
invest.
know. We don't
Yes,
know how
yes,
long
sir.
we will survive.
Correct, sir. Correct, sir. For you, usually the bonds what we suggest, so that it's secure and you get 7-8% return. So that is what the senior citizens aim at.
Now, what about the senior citizen savings scheme and
Yes, sir. Yes, sir. See, your main aim is to protecting your money, sir. It's not
exactly?
growing your money. Your main aim is to protecting your money. Yes, there are senior citizen schemes,
Uh,
and these bonds, you can keep the money there, sir.
Thank you.
Mr. Srikanth, can you unmute yourself? Srikanth Ramana Gowda.
Okay, can ask next, I think. Yes. Unmute. Dr. Srikanth, you unmute. There's one more question popped up. Can you see that? It missed. What is the upper
Yeah.
limit of saving? Some question. I think they can ask what that question. I did not get that question.
There are actually several in the chat box. Shall we go one by one while Dr.
Yes,
Srikanth
yes.
figures? So
Yes, yes.
Ashian has asked on comments on apps like Upstocks or Motilal Oswal.
Yes, as I said, no, sir. There are top. You can just check it in the nowadays. Finding the things is very simple. You can go to the Chat GPT or any AI thing and ask which is the best. You'll get 1, 2, 3, 4, 5 based on the criterias. So we don't recommend any of the platforms. Yes, commonly used nowadays is Upstocks and the Zerodha. Anyone should be all right. Dr. Srikanth is telling unable to unmute. Can you check once? Meanwhile, you can ask the question, Dr. Gayatri.
Dr. Srikiran has asked your advice on investing in ULIP like SBI Smart Fortune Builder versus SBI Magnum Specialized Investment Fund.
See, usually insurance and investment, you should never mix it. So that is not a good idea at all. See, if you think about the insurance, only few insurance we tell. One is the health insurance, which is very important. Everyone should have the individual health insurance, not just a family floater. And second thing is what is called as term insurance. If you think that to protect for your dependents, term insurance, where the premium is less, the coverage is more. And third thing is, yes, if you have a vehicle insurance. So health insurance and the term insurance, these are the only two things we say. Whatever you see in the LIC or whatever the companies, so you need to find term insurance. Any other insurance are waste. So you should not mix health insurance and the investment. So Dr. Shrikant is asking where can we find that gold SGBs? Yes, in Demat account you will find those things.
On the topic of SGB, Dr. Ankur has asked how much interest is mentioned in SGB.
8%.
Okay.
So
See,
Dr.
one is 8%. No, not 8%. I think it's around 2 to 3%. But important is it grows on an average 8% per year. That is more important.
This sounds like a compound interest.
See, I'm talking and my bubble is, then the AI is activated there. It's giving some answer. Okay. Such a
So,
powerful thing, AI now.
Is
Is
it
it good to invest silver and other metals? Yes, yes, definitely.
so Dr. Vibha has
See, that's
asked,
what, no, the diversification comes there. The 10% of your portfolio should be in the gold or metal. You can say gold and silver you can invest. Yes.
Dr. Vibha Verma has asked what is the upper limit of saving? Is there such a thing?
No, no, no. There's no upper limit, lower limit. Lower limit means minimum 20% you have to invest. More the better.
No, so my question is like, I'm a single woman and I have my parents to look after. So I feel I get just confused in how much to save. And what will happen if you're putting so much in your MF? You will die one day. So who will be there to benefit from that? But I'm asking about myself.
Now, got the point, madam. So you need to divide how much is the expenditure is required, how much is the luxury required. At least some amount should go to the savings. Savings is very, very important.
So I'm
So keep
saving.
minimum 20% saving. Rest you enjoy.
So the problem is I don't enjoy also, but I'm always asked by the bank people that the moment there is about 5
Salary.
lakh saving, they start telling you put here, put there. Then I lose track. I lose track of where I have saved, what is maturing, what is coming back, and I really don't know. I get worried when people ask me to put in this much over here, this much over there.
Yes, it's a very valid point. If you ask your friends, most of them have the same point. And your money is just leaking in the sense you don't know where all it is distributed. If you see your account, only few thousand, few lakhs, many things will leaked out. It may be there or you may spend it. So one of the best way is to create this demat account and streamline the money to the demat account. This is my own experience. When I started a demat account 5 years back, it's only the minimal amount. Now the amount of growth, it's a phenomenal. In the sense, the leak of your money stops. So simple way is to streamline it. As I said, no, there is an expenditure account, there is an investment account.
Now, I really
Once you
like that.
create that,
That is very.
yes, see, that's what I'm telling. Once you come to the investment account, once you start a demat account, all the investment comes to one place. So tracking becomes very easy for you.
I think that is important. It's for young people. You should have 3 accounts. I think it's a very good advice.
Yes. Dr. Vandana is raise the hand. Yes, you can unmute and ask question.
Yeah. So, I just want to know. I recently went to a conference, and there is a stall was there. There is like a company. There is a company was there. They're telling that they will invest on our behalf. Just we have to tell that we have to save like 10,000 money per day per month, and like they will divide into multiple, and they purchase some equity and all that. And they have app. We can see how much our money is growing and all that. So how much you recommend? We don't need to think anything. They will do on our behalf. So how you recommend this thing?
Madam, do you think he'll do free for you?
So that's why I ask us, what are the
Madam,
benefits you
very,
have?
very, very simple things to understand. Anybody comes to you, they're investing for themselves. See, how many times you got a call from the LAC that take term insurance? Never.
No, no,
But you
no.
get regularly from the SBI bank. Even SBI also the term insurance. SBI for these ULIP schemes. See, they're doing their business for earning themselves. So that's what I said. Very simple way. The today's talk is you don't require any knowledge. You know how to open the computer. You know how to search in the Google. You know how to type accounts. Very simple manner to open the Demat account. Once you open the Demat account, see like that those steps you can always reach out to us. Even if anyone wants to do this Nifty Bees, Junior Bees, what I'm talking about, the technical details of how to do that, you can directly connect with me. I can guide you people. No issues at all. So
Sure, sure.
once that is set up, no, you anybody says that you will keep the money or give the money, I'll invest. You just say no, I'm investing my own. That's all. Cut.
Yeah. So that's why I was wondering, like, how much the safest money? We don't know, and how long the company will be there.
Do you
But
know? Do you know in the bank what is the safe amount you can keep in the bank? You kept the money 1 crore rupees in a bank, yes bank. Okay, so it's gone bankrupt. How much money you will get back?
5
Can
lakhs.
mm,
anyone?
5 lakhs.
Yes, only 5 lakhs is guaranteed. 95 lakhs is gone. So money is not safe in your bank also. So very important it is.
so what you recommend? Best is the way to invest the money to purchase the land. Like if you have saved some money and then purchase the lands, is
No,
it
no.
good?
Again, I'm telling you, no, madam. You have to diversify. Real estate 40% it will come. So
But
don't keep
depends on
everything. See, like for example, you have 100 crores worth of land. Now immediately you rake 1 CR or 2 CR for various reason, your family members or some health problem. Immediately you require 2 CR. Do you think you can sell 1,000 crore real estate on spot and get 2 CR? I'm just
No.
giving an example. So liquidity won't be there. Liquidity means buying and selling part. You have a worth of that asset, but you don't have a money in your hand. So that's why the diversification is very, very important. The money in the stock market is liquid. Not that you can you can get any time, but I'm just telling that. So always better to diversify the amount.
Okay, sir. Definitely, I would contact you regarding opening this Demat account and all that because I have no idea zero account.
So other thing is, as I said, no, I also learned from the Wealthcon. Wealthcon is an organization run by the doctor. Dr. Ramnath Gute is the founder of that. There are thousands of doctors like me and who started from the scratch. And right now I'm sitting and I'm talking. 5 years back, I was like you only just listening or searching and nothing, knowing nothing. So if you're really interested, yes, definitely you can join the group. It's not the paid group. All are doctors only. Once you ask the question, the answer is given by the doctors only. And there are hundreds of doctors in Bengaluru itself who are part of the Wealthcon, who are spreading the knowledge to the fellow doctors.
So can you
So if
share
you're
the link
really,
to this?
yes, 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 we'll share to you and you can share in your group. Whoever interested, you can join. And in that also there are course, the basic course, advanced course are there. Whatever you like, you can learn and you can earn. If you don't want to join, you don't want to learn anything also, The basic things, if you join those groups, these basic things, you can ask the question, the material is available. So you can go through the material, you can get benefited. You don't require to pay. The 80% of the work, what is happening in the Wealthcon is free of cost.
Sure, sir. Thank you, sir. Thank you, sir.
Yeah.
So Dr. Srikanth has asked, where can we source gold bonds in secondary market?
Same only in the Demat I answered already. In the Demat account, it's there.
And also Dr.
Gold investment.
Dr. Selva has asked that apart from SGB, any other digital gold investment available, sir?
No, there are available, but we don't recommend those things. And I don't have much knowledge about those things also. See, one of the point I learned from my mentor is whatever you want to learn, you learn. Rest of things, I don't have knowledge. Whatever I'm talking, no, I know. If you ask, I'm not a finance expert, but what I'm talking, I know. If you ask many other things in the market, no, even I don't know because that is not required. Why do you want to break the head for that? So like that. So digital golds and all, we say it's not good, but why and all explanation, I don't have much. So SGB is the good thing. And you have in the Bs form also, ETF form also, you have what is called silver Bs, gold Bs. Like I said, Nifty Bs, junior Bs, no? Similarly, there is silver Bs and gold Bs. So if you don't, SGB means require little more money to buy. The Bs are very small amount, like 100, 200 rupees.
Doctor, seminar coach on finance.
Seminar coach on finance. Allah, FinQs, so you have all the detail about the SGBs and to find which is best and all those things, technical details, FinQs, finqs.com.
Right. Dr. Sudeep has said that PPF is a good investment for youngsters. 1.5 lakh per year will compound a lot, and withdrawals after 15 years are tax free. Any comments?
No. Again, that comes under the diversification of the debt product, the GRED. Only 10% you can keep it. The interest you get is, it used to be 9-10%, now probably around 7.1%. That's what the interest right now. So I explained, if the 7% return means how many years it will take to double the money. It's not about the 1.5 lakhs doubling. It is the return on the 1.5 lakhs.
Right. Dr. Bhushan
The
wants to
only way to grow money is equity. That's the only way where the money grows.
Dr. Bhushan, if you would want to ask your question.
Yes, madam. Good evening, sir.
Good evening.
Now, probably I think of late I have started understanding, a little bit, and I'm trying to get financially educated. But I have started investment some 4 years back, though that time I was not aware. So I was taking a help of the wealth management companies. So they have done certain investments in mutual funds. And as I can understand recently, those are all mutual funds are regular based, what you have been telling, sir. So, now I am understanding that we should do the investment by ourselves rather than going through an agent. So is it good thing for me to stop those investment and without knowing full knowledge about the market and the market share, should I invest in ETF and what you said, that Nifty Bs and the gold Bs to start my
Yes, sir.
trading journey,
Yes,
sir?
sir. There's no doubt about it.
So that would be a better one, sir, for me to
Yes,
start.
that's the best. So best way is to, if you are continuously putting the money, you can just stop the SIP. That's all you required.
Yes.
And you're not going to lose anything. Generally, as you are not aware of these finance things, they try to scare the agents.
Yes,
In the
sir.
sense,
Yes.
if you stop, this will decrease. You need to keep to grow. And if you exit, there is an exit load. See, exit load is only for the last 1 year investment, what you have done. For
Okay.
example, what invested in the last December till next December, this December, there's no exit load for that. So not
Okay.
whatever you invested in January, yes, still the exit load. So anything you invested before last December, this exit load is gone. And exit load is around 1% return. Even
Okay.
if you exit and invest in these products, that 1% you are already giving to the agents.
Yes. Yes.
So if you exit, you are going to give to the AMC. that
Yes.
1%. If you
Yes.
don't exit, that 1% you will give to the agent.
True.
Ultimately, you don't lose anything.
Sure.
Don't lose means there's no extra loss. That
Understood.
1% is just getting diverted to different person. That's all.
Right, sir.
So you can stop the SAP and just, if you don't know anything, you can just invest in the ETFs. If you think that the mutual fund is giving the good return, which they have done already research, same mutual fund you can buy in a Demat account. There is a coin account in Zerodha. Like
Yes.
that, other accounts are there. Same mutual fund, direct you buy.
Okay. Should be good, sir. Thank you so much, sir. Thank you.
Thank you. Thank you.
Thank you. And Dr. Sameer has asked how to select the ETF for investment.
See, there are many ETFs in the market. So few people, the what I'm explaining to the persons who don't have the knowledge, who don't want to learn finance. That is Nifty Bees and Junior Bees. They are Nippon ETFs. So you don't require to break much head in that. There is one website, NSE website, what is called www.passiveinvestment.com website. If you go to that website, you get all the ETFs. So you can compare those ETFs based on the returns and based on the what you call expense ratio and what is called as liquidity. Liquidity means what? Buying and selling. See, like in the stock market, if you are buying means somebody is there to sell, something like that. Okay. So if more people are buying a particular product, that means there will be more people to take it. So that is called liquidity. So expense ratio should be less and the liquidity should be more. So you can find those stocks. There are private companies, they have the ETFs on these things. And again, there is what is called as a sectoral ETFs. Sectoral ETFs means related to the health, there is an health ETF. And combined Indian companies, there is a ETFs. And defense sectors, there is an ETFs, what is called as more defense. Like that, more energy, like energy companies ETFs. So you can keep investing on the ETFs only. The advantage of investing in the ETFs is the companies keep changing. You don't require to monitor the company. If you know that one sectors, now the health sector is the one which is the future. So investing in a company, again, it requires a constant monitoring. But if you buy the ETFs, you don't require much monitoring.
Dr. Shrikant has asked about postal investment.
Postal investment, again, they're all debt products only what we get it. And some of the products are like an life insurance. Anything they say insurance and the investment, you just say no, you don't require to think too much. They say no, your accident cover is there, death cover is there. So if they say any investment having those covers, you just say no. If you want to cover, that is to protect your dependents, you take the term insurance.
All right, sir. Any other questions?
Is it advisable to have exposure to foreign equity market through ETF? Again, Dr. Sameer has asked.
There is one ETF called MON 100, MON 100. That is exposure to the foreign companies. The Parag mutual fund, Parag Parik mutual fund. Okay, these are all foreign companies exposures.
So when we open, say, an app like Kite in Zerodha, and I search Nifty 50, it says NSE, BSC, then there's Nifty Bees. So how do we?
NSE and BSE. NSE, BSE is the stock exchange. National Stock Exchange and Bombay Stock Exchange. Bombay Stock Exchange started early and NSE started later. Both are in the Bombay. So both are okay, but NSE, the people trading are more. So what I'm talking about the liquidity, you get more in the NSE.
So better to invest in NSE over BSC.
Yes, yes.
So, any other questions anybody has?
I just have a general observation. I think these are the kind of things, I don't know, maybe what your take is. I think, financial management and the investing education is something that they should teach in schools, in high schools, because, I feel even 35, 40 is too late, like you said. So, I mean, this should be part of the curriculum, I feel. I mean, I don't know. I think this is stuff that is a valid, like, essential life skill that we miss out on in our education, policy or program or whatever. I really think we should spread the word, start early, maybe, our kids or whatever, but on a institutional level, I think it's something that really needs attention,
Correct.
because we're grossly undereducated on the things that matter, I feel.
Yes, yes. See, regarding that education in our Wealthcon banner, no, we have what is called as fine groups, the future investor group, and we teach between 6 to 8 years, 8 standard students
Oh,
the
excellent.
finance, and basically these students are from the Wealthcon members, the group doctors who are in the Wealthcon. So yearly, we teach them regarding the finance and regarding the most of the things, in the sense not only the finance, there are many verticals we teach them.
Excellent.
And one more thing, I think one question I saw in the chat box, where can we keep the money for the short term? So one is the short term FD. Other thing is in the demat account, there is a instrument called liquid case by Zerodha. It is liquid case. So that is also a debt product. You can keep it at least 2-3% or 4% returns will be there, but the money is safe.
And
So less than 5 lakhs means you can keep it in the bank only. But if you're keeping the big amount, as I said, bank is also not safe. So in that liquid case, we can buy. Yes. I think should be done.
Dr. Srikiran has asked one last question. What is your take on specialized investment fund versus mutual fund? Returns are same or one is better over the other in the long run? And should we consider both options or just one?
See, like if you can able to find the best mutual funds, it's always better to have your own mutual funds. That's direct what I'm talking about. Otherwise, if you're dependent on the fund managers, yes, you can take that. As I said again, no, what to be done, I have good knowledge, and many other things, yes, I don't know much about those things. If you ask me the mutual fund, yes, which one to buy, how to buy, and all those things, we know. But as he asked the question, no, I don't know the details about those things.
Thank you, sir. Thank you so much for giving your precious time to us. And I think this has been a very insightful session, which has helped all of us, especially some of us who are extreme beginner level in investing. This really gives us a place to start from. If there are no other questions, I think we can close the session now. And we would request you to please share the link to your WhatsApp group. Is it wealthcon.com?
I will share, madam. I will share with either Shruti madam or Gayatri,
Yes, sir.
and they can share in our groups. And whoever is willing to join and learn more, learn and earn, then they can join.
Thank you, sir. Thank you so
Yeah.
much. With this, we'll close our session and we will meet again in our next session, which is going to be in the new year, the first Tuesday, 8 p.m. Stay tuned for the topic. That is not decided yet.
Yes.
Thank you.
Thank you very much. Thank you very
Thank you
much
so
for the
much.
opportunity. Thank you. Bye.
Bye, sir.